Meta is one of the most powerful computing businesses in the world with massive installed base in these data centers, especially in North America and Europe. But let's focus on the outlook for capital expenditures because it's not the past, it's the future that tends to move stocks in big ways right after earnings reports.
Welcome back to Chip Stock Investor. Earnings season rolls on, and we're going to focus today on one of the top big tech companies out there, Meta. With the Fed most likely keeping interest rates higher for a bit longer, big tech is still an excellent place to place your money in your portfolios. We're going to unpack Meta's most recent earnings report. But first, I just want to remind everyone that we have a membership that you can join here on YouTube or over on our Ko-fi page that gives you access to our Discord channel. And on that Discord channel, you will find a ton of exclusive content, great discussions with our investor community, and all of our published manuals and show notes, all a great value at just $5 a month. There's our plug for that. Make sure you check it out. Link is in the description. With that said, let's jump into it. Let's talk about why Meta stock fell yesterday.
Yeah, as of this recording, pre-market on Thursday, April 25th, we're down, let's just say, well over 10%. Kind of looks like a disaster. But Kasey, walk us through the numbers here. This was far from a disaster.
Yes, take a look at that revenue for the last 3 months, up 27% year over year to 36.4 billion. Operating margin at 38%, up from 25%, and the earnings per share up 114% year over year.
Yeah, talk about operating leverage, right? So the year of efficiency continues into 2024. We have a brief little snapshot there in the bottom left of Meta's performance in 2023, 16% revenue growth equated to 73% growth in earnings per share. That's Meta not just continuing to grow, but winding down some of its elevated expenses from the pandemic. That is set to continue this year. You can see the general trajectory here, still very much up and to the right on a year over year basis. Of course, Meta always gets the big seasonal jump in the fourth quarter during the holiday season in advertising revenue. That's why you see the sequential drop. But on a year over year basis, which is the more appropriate way to analyze this particular business, you can see really solid trajectory. But Kasey, what's interesting here is the thing that has investors freaking out a bit and that has the stock down following the earnings report is the Nvidia tax, let's call it. Meta's CEO and co-founder Mark Zuckerberg talked about the pivot from the metaverse a couple of years ago now to artificial intelligence, AI. And it sounds like Meta is going to be spending a lot of money on NVIDIA AI systems, right?
Take a look at this slide from Meta regarding their capital expenditures. In the last quarter, it's actually down to 6.7 billion, and annually in 2023 they only spent 28 billion versus 32 billion in 2022. So, yes, investors are worried about this Nvidia tax, but why exactly are capital expenditures actually going down?
As we've explained in some of our past videos, what happened in 2023 especially, and we have a bit of carryover here into the first quarter of 2024, is there was a big reduction in what we can now call legacy cloud computing infrastructure. That's all of the old non-accelerated computing, non-generative AI systems and infrastructure. So that was a big part of why the semiconductor market, the enterprise compute market, excluding AI, was down so badly last year. So companies like Marvell Technology, which we've covered extensively, got hit pretty hard from that. They took it on the chin, and then companies like Nvidia gobbled up all of that CapEx. So based on this slide alone, Kasey, it looks like the Nvidia tax actually isn't that bad. What's the big deal? There's nothing really to worry about here. here's what has the market concerned. We're going to come back here a moment to the revenue growth and what that means for earnings per share later. But let's focus on the outlook for capital expenditures because it's not the past, it's the future that tends to move stocks in big ways right after earnings reports.
Yeah, absolutely. They said that they expect their full year 2024 capital expenditures to be in the range of 35 to 40 billion, which is increased from a prior range of 30 to 37 billion as they continue to accelerate the infrastructure investments to support artificial intelligence. Broken down into simple terms, in order not to get left behind technologically, everyone has to spend on accelerated compute infrastructure. And that's what shows up as capital expenditures in companies' cash flow statements. So, full year total expense outlook for Meta is 96 to 99 billion, which includes the effects of higher CapEx. And that implies an increase of just 9 to 12% in the coming year.
Yeah, but just to emphasize and reiterate this, the capital expenditure outlook is what has the market spooked because that specific increase, which is included here in the total expenses, is expected to increase 25% to 42% in 2024. The worry is if that CapEx continues to ratchet up this year, and Meta management actually said that spending on AI infrastructure is likely to continue rising in 2025 as well. The market is worried that some of the renewed discipline on costs in the last year is going to be undone. And that those nice profit margin increases that led to the huge earnings per share growth in the last year will get unwound by elevated AI spend. Now, ultimately, Kasey, what this means for NVIDIA shareholders is it sounds like they're going to continue to gobble up a lot of that CapEx that's going to flow into NVIDIA's revenue. This all but confirms NVIDIA is going to grow at a very rapid pace in 2024. And that growth could actually continue into 2025. This is a pretty good indicator of that. Meta, its other consumer internet peer, Google, and really all of the cloud giants, Microsoft, Amazon AWS, Google Cloud, Oracle Cloud, they all have these data centers all over the world that need filled up with this AI infrastructure, accelerated compute infrastructure. Meta is one of the most powerful computing businesses in the world with massive installed base in these data centers, especially in North America and Europe.
As we've talked about before, Meta's custom silicon is about long term operating efficiency, not simply catching up or even competing with NVIDIA, especially not in AI training. These custom chips are all about saving a bit of money in the long term for AI inference once the AI has been trained and put to work. These custom chips from Meta are great news for companies like Broadcom, which are helping with the design work.
But Zuckerberg and company did reiterate on their earnings call that as for the high end training and accelerated compute infrastructure, which really helps fuel Meta's research and development of future products, future AI algorithms that can help with advertising recommendations and help with their ad customers with marketing campaigns. It is really still all about NVIDIA, those MTIA chips from Meta, co developed with Broadcom, really not a like for like comparison with NVIDIA's high end equipment. It's an important thing to bear in mind. Check out our last video that we did on that, link to that Broadcom video below in the description.
Let's talk about Meta's Reality Labs segment for just a moment, because as ugly as that CapEx guidance looked, the ultimate takeaway is that Meta is still focused on operating efficiency. The company opened up its VR ecosystem to third party developers, which, given some time, we believe will help rein its expenses in. We'll be posting an article over on our community board about that soon. Check that out.
Yeah, that's right. We did see a little bit of progress, it appeared, in Reality Labs in the first quarter, a slight $150 million dip in operating losses in Reality Labs. Management did say that those operating losses are probably going to go higher this year. However, as you mentioned, Kasey, we will be posting an article on our community board that we wrote about this. They launched this Horizon operating system, opening up all of their virtual reality and mixed reality tech to third-party developers, both on the hardware side and on the development side. Maybe after 2024, I think we should maybe start to pencil in the expectation that those operating losses start to decrease from here on out as Meta kind of shares some of the research and development burden with new product development partners. So we think this is a really positive sign long term. As you said, Kasey, CapEx looking ugly. Here's a look at Reality Labs operating losses over the last 5 years, topping 50 billion in losses, which is kind of chump change for Meta. Believe it or not, this is one area where they can actually make some really, really big improvements in the coming years and keep operating efficiency on the rise overall. So that explains why we think the market kind of soured a bit on Meta after what has been an epic run in the last year. Stock down well over 10% after the Q1 update. But we don't think this was all that bad. This is maybe just a bit of a breather.
Yeah, the Q2 2024 outlook is still very solid. Revenue is supposed to be in the range of 36.5 to 39 billion, which implies a year-over-year growth of 14 to 22%. Not bad. And just as a reminder, full year total expenses 96 to 99 billion, and that includes that effective higher CapEx, and that implies 9 to 12% year over year. Profit margin expansion still in play for Meta after this epic year of efficiency. Let's talk about valuation for the stock right now.
Yeah, after this pullback, we have, for our estimate, earnings per share growth of about 40% in 2024, over and above what they reported in 2023. So that gets us to about $21 in GAAP earnings per share for Meta in 2024. That means the stock currently at a share price of roughly $420. That's a 20x expected earnings per share multiple. Again, our baseline estimate, we think Meta has a lot of levers to pull. Of course, the stock buyback plan still very much in play here. That could also increase the earnings per share by a pretty decent amount this year. Our ultimate takeaway is this: as you said at the outset of this video, Kasey, with interest rates expected to be higher for longer, base case scenario, we're maybe looking at just one or two interest rate cuts this year from the Fed. That really does, unfortunately, favor big tech or the Magnificent Seven or whatever we're going to call them at the moment. And of the Magnificent Seven, Meta remains actually one of the best long-term values based on their potential to grow earnings in the next few years. So after this big pullback, I think we're actually looking at adding to our long-term position in Meta. Stay tuned for some updates because we're going to make some portfolio adjustments based on what we're seeing with capital expenditure trends from Meta and other big tech companies. We may end up consolidating our chip stock holdings a little bit, maybe parting ways with some of our longer term underperformers again and reallocating some capital. We'll update all of you on that. And of course, hop on Discord and check that out where we'll have some discussion about what we're doing and why.
Very good. That's a wrap on our coverage on Meta. Of course, the free and easy way to support us is to hit that subscribe button. We really appreciate all of our viewers out there. Hit that subscribe button, please. We'll see you again very soon. We have more coverage coming up on Visa this weekend, and we have top stock for us Lam Research that we'll be covering. So stick around. We'll see you again soon at Chipstock Investor.